So now the next step is we have to distinguish between different types of capital. Up to now I always said net worth, equity, capital, all the same. And by large, as a simplification, I think that's okay. But if you look at regulation, unfortunately, we have to distinguish between so-called Tier 1, and Tier 1 is distinguished between common equity Tier 1, residual Tier 1, and also Tier 2. Now, there's all this complicated stuff behind it. I just spent a tiny amount of time on this one. The basic idea here is the following. Common equity Tier 1 is proper equity capital, the one that we've used all the time. Ordinary shares, retained earnings, all these kinds of stuff. So this is standard equity capital that we know. Residual Tier 1 is something that is a little bit in between capital and kind of has the aspect and characteristics of debt. For example, it says here perpetual non-cumulative preference shares. So preference shares have certain rights. They have rights to be paid dividends, for example, in the future. So it's a little bit similar to a liability. And that's the reason why they say, well, it's not as good as equity, as standard equity, because it's a little bit like a liability. And with Tier 2, it's even worse. So here we have subordinated debt. So this is actually not equity at all. I'm personally a little bit annoyed that they call this capital, because this is not capital, this is really debt and liabilities. But these are liabilities that are ranked very far behind. That means if the bank is going into insolvency, if the bank is getting into trouble, these guys have said, okay, we don't get repaid then. First pay the depositors, and then you can repay us. So therefore, it's also a little bit of a buffer to protect the depositors, and therefore it's similar to equity capital. That's the reason why they're included here. In the news, a hot topic that we don't have time for in this class, but you might have heard of contingency convertibles, COCOs. So this is basically a bond, so a liability. But there's something in the fine print. In the fine print it says, if certain things happen, this bond becomes a share of the bank. So all of a sudden, it becomes, from a liability, it becomes equity. It's convertible into equity. And they're called COCOs. Now, why did I call that COCO Pops? Usually it's converted at times when the bank is doing huge losses, when the bank is not being healthy. And now I can imagine, if you invested in a convertible bond, they usually have higher interest rates than normal bonds too. And you don't know much about finance, you think that's perfectly fine, I've got a bond there, they have 10% coupons, looks fairly good. But now the bank is going towards insolvency, they're doing lots of losses, and now you get the phone call say, congratulations, your bond just became a share in the bank that is taking a dive. Step one, are you happy or not happy? Most likely not happy, because the share price is plumbing down. So now your bond is gone, you've got shares, the shares are diving, so most likely you're going to lose money, and that's the reason why I said here, Cocoa Pops. Be very careful. So even in the Australian Financial Review, I recently read an article where they said, Cocos, much higher return than normal bonds. Go for it. Low risk. I would be careful with that one. I don't think they're low risk. I can imagine there's quite a bit of risk in these things. So be aware of the fine print on these things. Otherwise, for this class, don't stress about it. All we need for this class is there's something called Tier 1, CET1, residual Tier 1, and Tier 2, and you have to have a certain amount on your balance sheet. I made this grey because the next slide is giving the same information much better. So the Basel ratios, which also have been applied by APRA in Australia, are the following. Of all the risk-weighted assets that we calculated beforehand, the 352, we need to calculate 7%, and the common equity, the CET1 that the bank has, should be at least 7% of the 352 that we had beforehand, in order to fulfill and get the tick from APRA. Otherwise, we get into trouble. If you have more, that's fine, but if you have too little, that's trouble for the bank. Tier 1 capital, all Tier 1, so it's including CET1, should be at least 8.5%. And all total capital, so including Tier 2, should be at least 10.5%. These are the regulations, and we can calculate these things, and we will calculate them in the final exam. Always hot things to use these numbers and calculate, so we'll practice these things. Good, for our example from beforehand, 3525, that was our risk-weighted assets for this bank. And we say that the bank has the following types of capital. CET1 is 20 billion. So imagine there's a balance sheet. On the right-hand side of that balance sheet, we have common equity, 20 billion. In percent, that is 5.7%. Question to you, 5.7%, is that enough? 5.7, is APRA, the bank regulator, going to be happy with this bank or unhappy? This is the regulation. Unhappy, they've got too little. That means they're going to get a visit by APRA, the bonuses are going to be cut, and they're going to be told, more equity capital. Shrink your balance sheet so you have less risky assets. So if you get that number down, then the percentage will reduce, or issue new equity via rights issue, for example. And look what happened here. So during the GFC, it turns out the banks had too little capital. APRA came in and said, you need more capital. We need to be stricter on this. We want you to have more buffer. And these are the real numbers. Banks cranked up their buffer. During that time, also lots of rights issues by the banks. And you remember maybe a few weeks ago I spoke about Deutsche Bank. Deutsche Bank, much too little tier 1 equity capital, so they still have to crank it up. Therefore, they're trying to issue new shares too and try to get their balance sheet into better shape. Good. So we in this class take a very simplified approach to capital adequacy regulation. The real regulation is hundreds of pages long, but we don't want to do all that nitty-gritty here. But I want to bring your attention to some of the things that link up with the things that we did in class. For example, in class we've learned that banks do suffer from interest rate risk. If the market interest rates rise, because banks usually have long durations on their asset sides, the value of the assets goes down, and there's a good chance that they're making a loss. So interest rate risk is a problem for banks, and losses are related to solvency, so therefore the bank regulator is looking after interest rate risk too. And they do that in the following way. So APRA is the Australian bank regulator. They say you have to have a certain amount of bank capital depending on how much interest rate risk you've got on the book too. This is basically all you need to know for this one here. Just if you keep in the back of your mind, interest rate risk is a risk for potential losses, and for potential losses, we should hold bank equity as a buffer. Similar for off-balance sheet. So gray means it's not that super important, but at the same time, I think it's useful that you've heard it once. So there's certain off-balance sheet risks that we can have. For example, we can have promises of future agreements and forward agreements. You can't see the future or forward contract on the balance sheet itself because it's not an asset. It's just a written contract where you say, if something happens in the future, or in the future we will have to deliver something at a certain price, for example. And that might mean that we make a profit or loss. Or maybe we even use it as a hedge, then it's neutral. But let's say if you use the future not as a hedge, but really for speculating in the hope that we're making a profit, we might make a loss. Making a loss can endanger the bank's solvency. And again, the bank regulator knows that one, anticipated that one, and therefore says, if you have certain off-balance sheet positions, like futures and forwards, or certain swaps or options, and they're not used as a hedge, but they're unhedged for speculation, then again, you should have more bank equity. Again, the details we don't need for this class. It's your turn. You're the bank manager. You want to maximize the return on equity, so you want to get the maximum profit for your shareholders. But you're already very close at your minimum capital adequacy ratio. Let's say you're already at it. So for example, your bank currently has exactly 7% common equity of your risk-weighted assets. So from the regulation point of view, you're not allowed to buy any more risky assets because then you would have too little equity. So the question is, in this position, which bond would you rather buy? The German 10-year bond or the French government bond, also 10 years? Now, what information do you need for this one? Firstly, we've got here the different bonds, countries issuing these bonds. And we've got here the ratings. Just look at the 2014 rating. So Germany is currently AAA, France is AA+. And over here, we've got the risk weights according to current regulation. Now try to figure that out. Number one, if you're allowed to buy German or French bonds. Number two, which one would you buy if you're the... First step is to figure out if they are allowed to buy them. And the German one has AAA rating. Risk weight is 0. That means if you buy lots of German bonds, from the regulator's point of view, you haven't increased the risk on your balance sheet. You don't need additional equity. So it's all fine. You can buy the German bond. For the French bond, it's AA+. So it's considered riskier. But the regulator said the risk weight on AA+ is 0. So from the regulatory point of view, it's just as safe as the German bond. So the regulator doesn't make a difference. You can buy either or. But if you want to maximize profits, of course, you want to get the highest yield. And the French one has a higher yield. Right? So you're going for the French one. What might be a counter-argument? Well, in reality, the French one is a tiny bit more riskier. So actually, you did increase the risk on the balance sheet. But because of limited liability, usually the banks are not too worried about the risk. Because remember, banks typically hold less than 10% of their liability side as financed via equity. 90% is other people's money, deposits. Remember, if you go into the casino and you play mainly with other people's money, if you win, it's fantastic. If you lose, tough luck for the other people. Similar with the banks. So if the bank loses, if they go into bankruptcy, they're losing only the small amount of equity that they've got. Most of the losses are going onto the depositors or deposit insurance. That's the reason why we have bank regulation. So you can see here, basically the bank regulation is not 100%. It would be better if the risk weight of an AA+ is a little bit higher than on a AAA. And there might be different kind of AAAs. There might be AAA bonds that are just AAA, and there might be AAA bonds that are really very good AAAs. So you can imagine you need to make the regulation finer and finer and finer and finer. Also, you can see here, if you look, for example, at Italy, 1 year it's AA-, a few years later, A-, then in 2014, BBB+. So it changes over time too. Now these rating agencies, they don't do the changes continuously every week or every few weeks. They sit down maybe once or twice a year. On corporate bonds, sometimes they don't rate things for 10 years in a row. So these ratings are often outdated as well. The point I'm trying to make here is regulation is always a little bit behind. It's impossible to regulate something 100% perfectly. And because you can't regulate something 100% perfectly, there's always ways to play the system. To not cheat the regulation, but to use that regulation and use kind of loopholes. So the fact that you can go all the way down to AA- and have the same risk weight as the German government bond with AAA, you can consider that like a loophole. So you crank up the risk in your balance sheet, but you can't see it in the risk-weighted assets at all. So that hidden risk is a problem. And that hidden risk is something when you watch the movies. They said that with the large firm in margin call, that it was hugely profitable and they made huge leverage that they otherwise never could have done because it was kind of hidden leverage, hidden risk. That's a similar thing to this one. So the securitized debt that they had in their warehouse was AAA, 0 risk weight. So they were allowed to use a lot of that one. And nobody took care for it. So in the meantime, the regulator saw that this is a loophole. And that's the reason why they put in this backstop, simple leverage ratio. So there they're going back to a very, very simple calculation. Basically, that they're taking the normal total assets, and they say your equity has to be at least 3% of total assets. So even if you're buying only AAA government bonds, all with 0 risk weights, so it's very, very easy to stick to these regulations because you have now pretty much 0 risk-weighted assets. So it's very easy to have 7% of 0, so basically you hardly need any equity. So it's very easy to make a tick on this regulation, tick this regulation, tick this regulation, not a problem, because you have 0 risk-weighted assets or very, very low risk-weighted assets. but then this regulation kicks in, 3%. So even though it's all AAA with 0 risk weights, 3% of however many millions you've got on your asset side, you should cover by equity on your liability equity side. So it's a backstop that banks can't play the system too much. If a bank is very, very, very clever and tries to get lots of AA minus or tries to find lots of bonds that are just above A plus, they get caught out by this regulation here. That's the reason why they put that in. We call this one here simple leverage ratio. Sometimes it's just called the leverage ratio. I find it easier to use simple here. And that's to limit gaming of the system. Remember what we've had here today, limited liability causing trouble. Limited liability causes especially trouble if you have too little capital, because then extra losses simply go to other people and you don't suffer from it. And that's the reason why the regulator jumps in and says, you have to have more capital. And when we calculate capital, we can't do the simple numbers as we did before in total assets to capital, but we have to look at risk-weighted assets, and we have to look at CET1, Tier 1 capital, Tier 2 capital, and we'll keep on practicing this.